If your charts look like a ball of spaghetti with 30 different horizontal scattered lines everywhere, you're doing support and resistance completely wrong. And it's probably the reason why you keep getting stopped out in Forex. Now, most of the beginners trade support and resistance like the razor thin lines. The market approaches your line, spikes through it by 5 pips to steal your stop loss, and then immediately launches the direction you predicted. Sounds familiar, right? In this video, I'm going to show you the exact 3 steps to map high probability key zones, spot the difference between the real break and the liquidity sweep, and execute trades with the tight stop losses. Let's head over to the charts. Think of support as the floor where the buyers enter the market, and the resistance at the ceiling where the sellers take over. But here is the secret. Institutional buyers and the banks don't enter their orders at exact price decimal. They operate in the price ranges. Now, when price approaches a level, the market wicks out to capture liquidity. If you use a single thin line, those wicks will kill your trade. By using a rectangle tool to cover the body closest and the extreme wick, you create a buffer zone. The zone represents the real supply and demand. Not every price bounce is worth it trading. To find the levels that actually holds, you need to follow 3 strict rules. The rule number 1, higher time frame priority. Always start on the daily or 4 hours chart. Levels drawn on 5 minutes chart contain too much market noise and break constantly. Higher time frame zone carry the real volume. The rule number 2, look for impulse move. Look for impulse moves. Don't just look for any pivot point. Look for areas where the price aggressively moved away. The sharper the drop or rally away from the zone, the stronger the imbalance of buyers and the sellers at the level. Rule number 3, role reversal or the flip zone. Most powerful zones are where old support turns into the new resistance, or old resistance turn into the new support. When the level gets broken and a hold from the opposite side, that gives you a massive confirmation. Now, how do we actually take trade without getting caught in a fake out? You never blindly place a pending order at the zone. You wait for confirmation. There are 2 main ways to trade zone. Number 1, rejection entry. Wait for the price to tap into your higher time frame zone, then drop to the 15 minutes chart. Look for a clear reversal candle like a strong rejection pin bar or an engulfing pattern. Number 2, break and retest. If price aggressively breaks through a key zone, do not chase it. Wait patiently for the price to pull back to the broken zone, show rejection, and enter in the direction of the break. Your stop loss should always sit comfortably outside the full structure zone past the extreme wick, not right at the boundary line. If you found this breakdown helpful, hit that like button and subscribe to the channel. Drop a comment below letting me know which currency pair you are trading this week. Thanks for watching, and I will see you in the next breakdown.